Hey guys, Akil here. Welcome back to the Trading Coach Podcast. Today we're going to go back to the basics and I'm going to explain some key terms that you need to familiarize yourself with in trading. I know we spend a lot of time here on the channel talking about a little bit of the advanced stuff, a little bit of the trading psychology, maybe stuff that sometimes goes over the head of newer traders. So if you're brand new looking to learn, this is for you. And if you're a seasoned vet, don't worry about it. This will be valuable as well, as remember, the advanced is nothing more than a mastery of the basics, so it's always good to refresh. All right, let's hop in. Different terms you'll hear in trading and throughout this week. Long and short, that is pretty much bullish and bearish. Buying, selling, right? Long, bullish, buying, short, bearish, selling, all the same thing. Bid and ask prices. You don't need to worry about this too much, but this always brings a little bit of confusion. Bid is the highest price that a buyer is willing to pay. Ask is the lowest price that a seller is willing to accept. The difference between the bid and the ask, that is your spread. That's how the brokers make their money. Pips, ticks, and points. All three of these are used to kind of, think of them as units of measure. So like a ruler, like a centimeter, a meter, an inch, right? Units of measure to measure change in price. Pips and ticks, those are smallest. Typically ticks are used in like stock markets, pips in Forex market, but they're the smallest change of measure to the right-hand side of the decimal. So think like pennies or quarter of pennies, whatever it may be in the stock market, in the Forex market now. Points are the smallest measure of change to the left. So when you're saying points, you're typically talking about in dollars. Like Apple went from 100 to 105, there's a 5-point change or something like that, for example. We're not worried about the pennies and stuff like that. Leverage. Leverage is what I told you guys earlier, what the Forex market had that allowed me to think I was going to make a lot more money in a much quicker period of time with a lot less money in my account. Leverage is basically a loan. You are borrowing money to be able to participate in the markets, right? So like none of us can actually participate. Well, I shouldn't say none of us. I don't know you guys, but it would be very hard for us to participate in the Forex market with no leverage. We would probably be able to buy like 1% of a position, something like that, right? So what leverage is basically saying like it's like a loan where they're holding collateral, which is called the margin, right? Where it's like, for example, if a trader has, let's say 100 to 1 leverage, just make the math easy, and they want to buy like a standard lot, $10 a pip, right? If they want to buy a standard lot of the euro dollar, right, that would be $100,000 worth of euro dollar. Again, don't get caught up too much over the money, the number, just the relationship. If they want to buy a standard lot of euro dollar, that'd be 100,000 unit size of the euro dollar. To do that, they would only need $1,000 of margin. Does that make sense? So for you having 1,000, it allows you to trade 100,000. Let me know if that makes sense. If you had 100 to 1 leverage. So you need 1% pretty much of the available cost. Does that make sense? It's always, we don't need to dive too deep into it. Again, this is one of those things that you can worry about later, because if you're not good at trading, it doesn't matter. And you shouldn't be using this for a while because you're not going to trade right away. But that's what leverage is. So I think most places, when I first started trading Forex, there was 200 to 1. 50 to 1 in the US. I think UK maybe 31. It depends on your broker and the laws of where you're at. But basically, yeah, it's like what would it be? It'd be like a home equity loan. Like they're loaning you money, but like you have to put up part of your house if it's not there. So again, don't want to dive too deep into that, but that's always a question we get about leverage. More volume. This is the measure of units trading during a specific session or time duration. Liquidity. This is the ease in which something could be bought or sold. Jason mentioned this a little bit with kind of the exotic pairs. Sometimes you want to be careful with them because there's low liquidity, and when there's low liquidity, it's not as easy to get your orders on, right? As retail traders, liquidity typically isn't a problem in a $6 trillion market. If you are an institution, you got to do some sneaky and really creative things to get involved. And that's why smart money institutional traders, life is a little bit harder for them and they're really tricky with how they enter the market. But it's good to understand that because we want to be on the same side as institutional traders. So we want to understand where they operate. But fortunately, as retail traders, we can typically go in and out with ease. volatility, that's how quickly price moves over a specific period of time. And if you guys are looking for a measure on volatility, I always found this to be interesting. Check out the VIX. It's an index that pretty much tracks volatility in the market. So it tells you when times are volatile, when times are not volatile. You can also look at specific indicators to do that as well. Last one, just a few orders before we take our break here. A market order, right? This is an order placed in real time. So if you hear us say, hey, I'm going to enter at market, it means that I'm literally clicking the button right now and I'm entering right away. Typically, we're using market orders when we're waiting for like a specific entry signal. So if I required like a higher high, higher close, so like a candle to close above the previous candle, and that was my entry signal, like that's the thing I needed to get involved in the trade, I would then do an at market order. So as soon as that happens, boom, I would click the buy button and buy it right away. A limit order is an order that's placed in advance. So a limit order would be like you saying, hey, if price gets to 199 even, I want to get involved at that level, right? So I'm putting my order on the chart with my broker saying that if price gets to 199 and hits that level, then boom, that's when I want to be involved in the trade. Typically you use this with, again, placing orders in advances. You usually use this when you're taking like profit targets and stuff like that. So predetermined prices. Stop loss. This is protection. Does anyone here not believe in a stop loss? It's funny. I wasn't the greatest student in high school. I don't remember a lot from high school. But I do remember this. I had freshman year, had gym and health. And I remember our teacher, Miss Singletary. And it was day one. She came in. And the first thing she did was she threw a bag of condoms on the desk. Right? And she said, when you use protection, you significantly reduce your risk of getting an unwanted surprise. Who would have known? That was my first introduction to trading. Use protection, guys. I don't understand why people don't believe in stop losses. I do understand why, actually, but it doesn't make any sense to me. It just shows a lack of knowledge, a lack of preparation, a lack of confidence. There's nothing wrong with knowing when you're wrong. Like, an underrated skill of trading is knowing, we'll talk about this in the next section, knowing when you're wrong and being out of the market as soon as you can identify that you're wrong. That way you lose as little as possible. But stop losses are orders too. Stops can also be used as a form of entry as well. So if you want to be like a breakout trader and you want to kind of get involved at a predetermined level in the direction that price is moving, you can use a stop order for that as well. So that's a little bit of the fundamental background. Hope that wasn't too much. Wanted to keep it kind of basic. So this episode came from a recent presentation that we did called Trading Unmasked. We do a few presentations and workshops throughout the year. The next one is coming in March. I don't have a specific date or sign up for you yet, but watch this space, pay attention, follow, like, subscribe, do all the stuff you need to do to stay in the mix. That way, when it comes, you will be in the know and you can sign up as soon as possible because we do put a ceiling and a cap on how many people we allow into the workshops. Hope you enjoyed the podcast. Until next time, plan your trade, trade your plan. Take care.